Welcome to the Blockchain Hustle, where I take a look at some interesting plays of how blockchain technology is opening up new business vistas across multiple industries. Hi everyone, this is your host Meenu Serene with another episode of the podcast Blockchain Hustle. Now in this series, we are looking into the question or the topic of how does a blockchain network and its underlying token get its economic value. Now, there are a few valuation metrics for this, and we spoke about velocity in the previous episode. In this episode, I'll delve into the other one called liquidity. Now, crypto projects or the token issuers, along with the crypto exchanges and the investors, they need their tokens to be liquid. So, what is this token liquidity? Now, liquidity describes how quickly, how easily an asset can be bought or sold without affecting its price. So, for example, fiat currencies are liquid. If I have a $10 note, I can exchange it with two $5 note and I'll still retain a $10 value. I can exchange a $10 note with 10 $1 notes and the price is not affected. It will still be $10. However, paintings and houses, etc., these are assets which are not that liquid. Now, whenever we are doing any buying or selling, we come across a few terms. Terms like bid, ask, a bid-ask spread, order book, and a few more. Let me just touch on a few so that we are aligned on it. Ask, when we talk about bid and ask is the price that a seller is willing to sell an asset at. And bid is the price that the buyer is willing to buy an asset at. And an order book is something which is very integral to a market. An order book is a collection of all the asks and the bids, all the offers to sell and to buy. It is a collection of all the currently open orders in a given market. And trade happens when these are matched, when the order book is matched. And the difference between the highest bid and the lowest ask is called the bid-ask spread. So if this bid-ask spread is low, the market has good liquidity. And if it is high, the market has a poor liquidity. When the bid-ask spread is high, it means that there is a lot of disconnect between the price that somebody is willing to buy an asset at and the price at which the sellers are willing to sell their assets at. So the trade doesn't happen. It is illiquid. Generally, we want to trade in the markets which have got good liquidity, simply for the reason that we can enter and exit our positions with relative ease. So how is this liquidity connected with the economic value of a token? How is it connected with the token adoption? Number one, the token issuers, they need users which can spur the adoption for their token. And for that, they need an efficient trading market. They need to make their token easily accessible to these potential users. And not only access, they also need to keep their tokens stable and liquid. Otherwise, it's very easy for these potential users to get dissuaded from acquiring their tokens. The volatility and the illiquidity scares away the traders. Acquiring tokens, trading tokens should be efficient. So you need liquidity here. The token issuers, they need some kind of an exchange listing so that their tokens can be traded, a marketplace for their tokens to be traded. So if they go to the big exchanges have a high liquidity, but they have prohibitive listing fees. Whereas the smaller exchanges, they will not help these token issuers much because the liquidity is less. There are lesser tokens and their tokens will not have much of a liquidity potential. And we see that for every token listing, it costs the exchange a considerable setup cost. So these crypto exchanges, they would like to list tokens, only those tokens which have got a high liquidity potential. Thirdly, the investors too like to invest in a token which has a high liquidity potential. liquid market prevents a very large order, a huge order, from disrupting it. So a liquid market helps to generate confidence in that token. So to sum it, lack of liquidity limits the token adoption. So how do you get this liquidity? Well, liquidity just doesn't happen. It needs to be built. So if we have a new token, how can the token issuers get a liquid market for it? How is liquidity added to the market? There are quite a few components towards achieving this, and I will pick on a couple: market makers and then the digital crypto exchanges. But then that's fodder for the next couple of episodes. So till then, stay safe and cheers. Bye-bye. You've been listening to the Blockchain Hustle. Did you enjoy this podcast? If so, please do leave a short review, like it, share it, download it, subscribe to it. What should I talk about next? Please do let me know your suggestions by writing to me at meenu@vlsiconsultancy.com or through any of the other contact channels as shared in the episode notes. Thanks.